Sir, we will now commence the program with the Energy and Price Outlook by Mr. Jaime Webster, Senior Director, BCG. Mr. Webster, I will now request you to take over.
Thank you very much for that intro. I assume my slides are showing. I don't see the slides. Okay, there we go. Thank you very much. A real privilege to be here with everyone to talk through some of the things that is going on with the oil price, as was just mentioned, some of the volatility, some of the negative things that we're dealing with, but also some real opportunities. And to me, I've had an opportunity a couple of times to speak in front of this group. I always appreciate speaking with future leaders who, just between you and I find more interesting than speaking with people who have been leaders for a long time. You often have a real energy about where the future can be. And I'm hoping that I can kind of give you some views on where we see things going. As I go through this, I'm going to be speaking for about a half hour, 20 minutes or so, and then you're free to ask some questions. There's a little Q&A in the bottom of your screen. If you have questions in the middle of it, please go ahead and put those in. If I happen to see them, I'll try to answer them as I'm speaking. But let's go ahead and get going on this. Next slide, please, unless I have control. Excellent, excellent. So let's first give ourselves a little bit of a context of kind of everything that has happened here. Oddly enough, at the beginning of this year, we started a year where oil prices were nearly $80. And since then, we have dealt with 4 successive shocks, several of which are obviously still here and are going to have long-term repercussions on where the oil market is going. That first shock began to happen actually in about January 6th, when the US and Japan started to shut down flights out of China. And this was the very beginning of an impact on demand, which then ended up spreading to a point to where in April we were down as much as 20 million barrels a day. This is again on a global oil market that's around 100 million barrels. And even if you're off by 1 million barrels, it can have a real impact. This was then followed up by OPEC Plus, which on March 6th of this year got together and were actually unable to come up with a plan and actually left the Vienna meeting with a no decision to cut production at all. And actually, they ended up increasing production for the next month and a half or so. This ended up sending prices, for those of you that remember, I believe it was April 14th, down into the negatives for 1 day. And we have obviously since come back. OPEC Plus, I think, really became quite frightened by everything that happened there. And they have since been really managing the market quite strongly. They just met a few hours ago, virtually, of course, just as we are meeting here, with the decision that they would continue forward. They're actually increasing their supply a bit in August by about 2 million barrels a day, which in normal circumstances would be a huge amount and still is. But for this, it's an appropriate sort of level, and they are very much focused on compliance and making sure that everyone is still sticking with the agreements. We also have an economic recession. For those of you who were not around 2008, 2009, when we had oil prices also deal with a very similar fall, that was about an economic recession. At that point, we had around 60% of the countries that went into recession. This time, it's expected we're having over 90% of the countries are going to be in recession. And this is going to have quite a while before we can actually work this out. In 2008, it took about 23 months before we finally came back to having demand to where it was before. This time, we anticipate that it's going to be a bit longer. And then the storage overhang. And I do see one question on the OPEC. I will get to that a little bit later in my presentation, but thank you for that. And please continue to ask those questions. I am absolutely paying attention to your questions as they come in. We'll do my level best to try to answer them. Then we had the storage overhang. Storage was a really big deal in April and May because there was actually a concern that we would hit tank tops. And tank tops is the term for basically that you would hit the point where you actually had no place else to put that storage. That was part of what contributed to the prices that were actually in the negatives there for that one day in April here in the United States with the WTI contract. Since then, we're actually seeing storage starting to come down, but we are at such a high level of storage that it's going to take quite some time for it to work its way off, and it's going to take it'll take quite a bit in order to overcome that. And so there's a number of countries where actually their production is offline right now. Venezuela, Iran, Libya in some ways. And that storage overhang can actually help to buffer that just in case if there's either an expected storage or less storage. Let's go ahead and move to the next slide. And this is talking through our demand supply balance. Of course, you have to get a sense of the demand supply balance. This is largely pulled from the International Energy Agency that just came out, I think last week. We've adjusted it slightly based off of some BCG views. What you can see there is the yellow line is where they expect demand, or where we expect demand to be, and supply being just under that. And so what you can see is that actually we are pulling, the green bars is actually showing that demand, that supply and stocks are actually going to be coming out of the market. And we actually anticipate that over the rest of the year. Some caveats, of course, associated with that. One is that demand actually does continue. I am sitting here in the United States, and we have some real difficulty in terms of our case counts, which had previously been rising. Now they're starting to fall again. But that is something that we're seeing is still a really big concern. And we've seen a number of other incidences in other countries, South Korea, New Zealand, where you're starting to see rising case counts. And this is a real concern in terms of the potential for it to reduce demand again, because of course, when you start to get, for many countries, when you start to become much more concerned about getting the virus, mobility starts to shrink, demand for oil also starts to shrink, and it also starts to impact negatively the economics of that country or that region. And so while this looks quite steady with a stock draw that is pulling out, it's got two major assumptions in here. And these are the two big areas to pay attention to over the next year or so. And that is, what is the demand recovery? How fast is that demand recovery? Does it kind of continue at this pace? Do cases start to come back? And so that's super important. And the other aspect is, what is the OPEC policy? Are they actually able to continue to manage the market? And can they, are they both able and willing to manage this market? So far, they've done what I would consider an absolutely extraordinary job. But the question is, can they continue this? Because their actions are really what is critical to be the counterpart to the rising demand scenario. And so those are the two things to really pay attention to. US shale is important, of course. The energy transition is important, of course. But over the next 6 to 8 months, the two most critical things to pay attention to is the recovery in demand and how OPEC Plus responds to that demand, because that is what is going to allow us to get a better sense on what the balances are going to be and how prices might come up and down. Next, let's go to the next slide. So the next thing is to talk about the global oil demand recovery, which we have a really long way to go. I saw one person I was interacting with a couple of weeks ago was like, oh, demand is back at 90% at the sort of level that we had before. That's really good news. 90% is actually at an astronomically bad level. As I said before, in the Great Recession we had, the biggest demand drop was just over 3 million barrels a day. And so when you're dropping by, the expectation this year is that we're going to be down between 8 and 9 million barrels, and that forecast is actually getting worse as we go forward. This is going to take quite some time, and is again why we believe that actually you're going to need to have OPEC to really step in there and actually do some things to keep production offline. We have, hold on just a second here. So when you look at this and when you think about this, there's a couple of ways that you can always look at kind of the top line demand number, which is before this whole crisis was around 100 million barrels a day. And that is down now to around 90 million barrels per day. But the other way to look at it that we often want to look at is two different ways. One, by country, and also by fuel type. And so our belief on the fuel type is that gasoline is probably going to be the one that is going to be the most critical part, that is going to probably recover the quickest. What we've seen on gasoline is that in a number of countries, people are actually going out and buying cars that had never bought cars before because they want to protect themselves from being in public transportation. And so you're seeing a real rise in gasoline demand. This is skewed by income level, of course, but that's one area where we're seeing a real shift in how people are using fuel in different ways than they had before. The fuel that is likely going to lag is going to be jet fuel. And what you've seen on jet fuel is that the expectation is that is going to be at least 4 years before they get back to the sort of flight levels that you saw in December of last year. Oddly enough, the one thing that we are seeing in terms of this intra-barrel shifting that we're seeing is that as jet fuel stays diminished, we're seeing a shift where the demand recovery for smaller private or contract jets is actually rising at a much higher rate than more the commercial jets, which is effectively the concern that you're actually having a divergence in how people are responding to this crisis, with those that have the economic means spending more money to try to protect themselves and their family, and those that are not still staying closer to home, still going into the businesses and things like that, but not able to make those sort of same changes. And so this demand recovery is going to take quite some time. To compare it to last year, if we could go to the next slide, if we compare it to the Great Recession, this is looking at how many months it took for the world to recover, meaning getting back oil demand to the sort of level that it was before the recession. On the whole globe, it took around 23 months. For India, it was less than 8. China was slightly slower than India. For the United States, which remains the largest demand area for crude oil and products, we actually did not recover until past 2014, when the prices fell again, and then we actually started driving again. This time, it's going to take probably even longer because, one, it's still unclear how long this issue and COVID is going to continue to impact our behavior. And a reminder that when there's often discussions about, well, once the vaccine comes and everything goes away, that historically, if you look at how pandemics end, generally they end not because the danger falls away. They end because people's risk tolerance shifts and they start to become they start to shift their mindset and how they react to it in ways that you would not have expected before. Sorry, I'm just reading a couple of these questions. I'll get to Priyas. Thank you very much for your question on the flights. So the question that he has is asking about could it be that we're seeing less flights carrying fewer numbers of people, and so you end up having more flights? That is certainly the potential if you have airlines that actually move to where you have a empty middle seat, and so you have a lower load factor, and so you need to have more flights. But what's becoming very clear is that if you are an airline that is not supported by the government or doesn't have some sort of subsidy to kind of keep going, which is a large number of airlines, but certainly not all of them, those airlines are quickly saying, we're sorry, you still have to have the full, all of those seats are taken. I just flew for the first time myself in about 6 months, 10 days ago, to go take my youngest to college. And I will say the middle seats were definitely in use in that case. For those airlines that are able to have a policy where they can have that empty seat, that is absolutely true that you will end up having more of those flights because, of course, the load factor is down, but people are still going to want to travel. Right now, what we're seeing in a few countries, and certainly in the United States, but also in Europe and a bit in the Middle East as well, is actually you're seeing a lot more flights by people who don't normally fly. I was speaking with an airline executive, and he was telling me that their biggest growth in flyers is what they call their VFR, visiting friends and relatives. So these are people that are not business travelers, but instead are traveling quite a bit because of the much lower costs. And so those are some of the shifts that we're seeing. And over the next couple of months and years, you're going to see interesting shifts in how demand recovers. And so the amount of gasoline that was needed before this crisis in terms of its share is likely to be different than the share that is required at the end of this crisis. So it's not just about lower demand, it's also about the intra-barrel shifting that is going to be super important. Let's go ahead and move to the next slide. The one thing that we wanted to take a look at BCG is trying to understand the fact that policies then drive behavior, which end up driving fuel demand. And so what we did was we created this shutdown oil demand index, which basically we track a bunch of different countries in a bunch of different ways on how, you know, our schools shut down, our businesses shut down, our large events not allowed, are there encumbrances or restrictions on flying out of the country or into the country. And then we weighted those by how much the oil demand was for that particular country. Because of course, you know, a policy in India to restrict movement would have a much bigger impact than, say, a policy in South Africa or some other smaller country. And what we've seen is that after coming down a bit, the demand those policies are staying relatively flat, but we are starting to see some upticks in a few different areas. Certainly here in the United States, we've started to see them. And there is a concern that longer term, you're actually going to have a second wave. And I've talked about some of that potential. If you have that second wave, that is again going to bring demand down again. And while this is a very useful index, we have also found that most people are obviously a little bit smarter than government policies and often will make the decisions to shut down, to stop moving sooner than the policies come into place. And so in the United States, we did an analysis, and basically you started to have the cases rise. About 8 days later, people started to slow down. And then a couple weeks later, you started to see actually policies starting to come back into place. So that's a look at demand. And as I said, demand is incredibly important to try to understand because it still has the potential to dip down quite low. The amount of demand that is offline is still really breathtaking. But let's pivot now to OPEC and take a look at that. Let's move to the next slide. So the first question, I did receive one question on if OPEC is going to extend production cuts similar to July and August. So right now, OPEC has decided that it is going to, it started to increase its production by 2 million barrels starting in August. It has a plan right now to keep production lower than it would otherwise through the end of next year. But what they were very clear about in their meeting just a couple of hours ago is that demand has been less, that the demand recovery has been weaker than they initially anticipated. And I think increasingly you're going to be hearing that more and more from several different areas. And so this is something where the potential for a demand decline is then going to impact OPEC Plus and will pressure their ability to actually be able to manage this. So they went through a real stress test when they had the April-May, when they didn't have an agreement and the oil price fell so dramatically, causing all of these major players to come back to the table. What this is looking at, this chart on the left here, is the current account balance, which is effectively the ability to pay for imports against the months of import cover, effectively how much is of their current account balance is actually required of their GDP, and how much months of import cover do they actually have in the bank. And so if you're in the upper right quadrant, you're in a much better position than those in the bottom left quadrant. And so you can see that actually the two big players of the OPEC Plus deal, Saudi Arabia and Russia, are actually in a good position to be able to continue down this path and to continue to have the sort of compliance and the sort of discipline needed to try to keep this production offline. They are really focused right now on ensuring that countries are complying, and those countries that are not complying, they actually want to try to keep that, to have them not just take the production down, but also to make up for any extra production that they had in prior months. Let's move to the next slide. So this is a slide looking very briefly at compliance versus how big their production is. And so that compliance is a percentage, as you can see, and this is just looking at OPEC, not OPEC Plus, because this was just the OPEC meeting today. Saudi Arabia, Kuwait, Angola, Algeria, and UAE almost are in alignment. And you can really see that the larger producers are in general in alignment, with the exception of Iraq, which has been having a real difficulty with trying to bring its production down. And there's been a lot of discussions. I know that the oil minister of Saudi Arabia called the prime minister of Iraq, who I believe is actually in the United States right now, to try to better get them to comply, because they recognize that if they start to let a couple of countries go and not comply, soon other countries will be not complying as well. The other one that they're really paying attention to, all of them are important, is Nigeria, and trying to get Nigeria compliance back up. So right now, I'm actually really hopeful that OPEC is actually going to do a pretty good job of trying to manage this market, but the potential for this demand to stay low is so long that it's really quite a big, it's going to be quite a challenge. Let's go to the next slide. One longer term upside price risk is on the capex cuts in upstream oil and gas. We had capex cuts in 2014, as you can see, but if you look at the graph on the right, what you can see is that because the service sector also cut their costs, the actual impact was much less. Versus in 2020, because you do not have the cut in service sector costs, the drop is actually much bigger. And this potentially sets us up for an insufficient investment in the upstream sector in the longer term. Right now, that is not my base case, but it is something to keep this in mind, is that there may actually not be enough investment being made, particularly if you have a demand return. And remember, you may end up getting, sorry, getting distracted here. You may actually end up having a really strong demand recovery if COVID starts to, is managed over the next year or two, and if you have a stimulus continue to take place. Let's move to the next slide. I want to talk real briefly on tank tops, which one, that's becoming, as I mentioned, that's becoming less of an issue. This is looking at the amount of storage that we have out there. It's a huge amount that is going to take several years to work off. And what that means is that that concern I raised on the last slide is slightly mitigated by the fact that you still have a lot of crude and products that is sitting there ready to be pulled once the market shifts. Let's go to the next slide. So we have had a lot of volatility, but oddly enough, from an oil price standpoint, the price that we had in the middle of June and the price that we had today has varied less than about $5 over that course of that time. So while it has been very volatile over a longer time period, over the last couple of months, it's been quite steady, remarkably steady, and it looks like it's going to continue in this sort of narrow range until we get a shift. Likely, my concern is that we're actually going to have a downward shift because of demand going forward. And so it is unlikely that we're going to be jumping back up to say a $60 level anytime soon. But longer term, that does look like that's kind of the longer term view of where prices will go. And let's look at the next slide. That is what we did was it is always difficult. So I'm an oil market analyst, so I'm always asked, what is my price forecast? And we all know that that's a very difficult sort of question. So what we did instead was we looked at different ways of looking at how different groups and at what different methodologies are looking at in terms of oil prices. And what we found is that most of them are around $60. The one that is different is the oil and gas company internal price forecasts, which are still around $70. But those themselves have been coming down. BP, Shell, I think Equinor all reduced their internal price forecasts, and it's going to be quite some time. Excellent question on when is it going to hit $100, just happened to see that. It is still possible that we could hit $100. The difference is that the market is so much more flexible now. If you hit $100, you would see this big boom in shale. And while I do think shale is important, the reason I don't think it's important right now is because in many ways it has been defanged. And so its ability to respond really, really quickly is limited. But if you had $100 oil, you would quickly see it drop back down. So $100 is possible, but realize if you see it, you should assume it is a very temporary sort of thing. Let's go to the next slide. This is BCG's internal, my group's internal price forecast. Wanted to share this with you. A lot of uncertainty around this. These are 95% intervals. So as you're seeing, I'm not anticipating it getting it much higher than where it is right now in the near term. There's a lot of downside risk. And so there's a big question mark on if we can actually, how much further it will go down if we start to have a real demand drop. With that, I will conclude. I think I have about one more minute, but please let me know if if I have any more time than 1 minute. Otherwise, I'll stop here. I apologize. I did not get. I was briefly able to look at the questions. I think I've got about 21 questions here. I managed to get a few of them, but I apologize, I did not get more than I wish I could have. But I don't want to get you off your schedule, so I will yield the floor. Thank you so much for your attention. Please reach out to BCG. I'd be happy to have a second conversation with you. Thanks so much.